Well, some of the data we got this morning just isn't great. In this video, we're going to go through the Richmond Fed data, we're going to go through the consumer confidence data, and we're going to go through some CFO data. A lot of this, some of the worst we've seen in the last 12 years. Keep in mind, a lot of these start compounding and they actually worsen each other. And volatile up rallies in the stock market are often faded in recessionary environments. We'll see if that happens today. This morning at a price target of 494 on the Qs, we're basically right there right now, so we still have that bullish momentum moving. Talked about that with everybody who's part of the Meet Kevin membership, which you get pretty inexpensively over at meetkevin.com. But let's focus right now first on some of these surveys, some of them the worst in the last 12 years, because they get signal some pain coming ahead. First of all, about 60% of CFOs, according to CNBC, are now expecting a recession. But the headline is actually less interesting than when you get to the key components of the article. They indicate that between Q1 and Q4 of last year, we've actually seen about a 10% decline in the level of capital expenses or capital investments companies expect to make. This is interesting because what about all those companies saying, oh, we're going to invest so much money into the United States? My unpopular opinion is that a lot of these companies are saying they're going to make these investments over the next 4 to 5 years, but they'll probably skew when they do that to maybe 2 years from now, to sort of that latter 2-year period. That way they can get through the uncertainty of the first period where we sit now on, well, are we going to go into a recession or not? This at the same time as this comment right here. CFOs actually expect Treasury bond yields to remain expensive or high between 4 to 5%. Well, this actually increases your cost to borrow for capital expenses in the first place. See, in my opinion, one of the best times to actually invest in, building out factories is if there's a recession, there's a panic, and rates go to zero. Well, now you can borrow very inexpensively for your capital expenditures. You could still have been honest in what you declared you were going to do, but at these yields, it seems like you have potential more negative weight ahead of you. Now, we've got multiple other surveys to hit this morning, but Bloomberg Intelligence this morning had a great piece where what they argued is that as bond yields stay high, you might actually find more pressure on top of the stock market. This is not uncommon. In fact, what you usually end up finding is the higher rates stay for very long periods of time, the more uncertainty you get, especially amongst Russell 2000 companies about how long they can really survive through some of the pain. And I think that's where you're starting to see some rolling over in the consumer confidence surveys really starting to freak out businesses even more. I mean, consider this for a moment. The consumer confidence index fell quite a bit. The present conditions component of it only fell about 3.6 points, not that big of a deal. However, future expectations fell to their lowest level in 12 years and well below the threshold of 80 that usually signals a recession ahead. Well, that's not great. Now, what is interesting is if you go lower into the actual report, there's some talk about the stock market that I want to point out. Right here. In November, we had about 57% of people expecting the stock market to continue to go up in the year ahead. That is now down to only 37.4% of folks, which is very interesting because usually the opposite happens. You end up having, this enthusiasm over stock. And when everybody's enthusiastic, that's your contrarian signal to get out. And, markets obviously topped soon after this November 2024 survey in about the beginning of January. Now, of course, we could always end up going to all-time new highs, but take a look at this confidence here because it's seeming less confident, especially amongst those who have actually been through recessions before. People 55 and older, and those between 35 and 55, though to a lesser extent, became significantly less confident. Those who were less concerned about the future were those under 35 and those households earning more than $125,000 per year. The problem, though, with this expectation signal is that oftentimes the soft data can end up rolling over into the hard data. That's why when you look over here at the CFO report that CFOs are suggesting, hey, we might end up wanting to spend a little bit less money on our capital expenditures because of that consumer confidence. These together are the leading indicators of poopy doopy coming, which isn't great. And when you look at, this is the conference board, this is a CFO survey from CNBC. When you look at the University of Michigan report, which on the St. Louis Fed website has not updated yet to its nastier preliminary data, but the preliminary data came in at about 64, which would be around November of 2023 levels, kind of there where it's hard for you to see there. This is going to drop about mid-range into this white box over here. So you're going to get a nice little drop if the final report comes in the way it did earlier in the prelim. You can actually notice that you can get rapid declines in sentiment at various times in the economy, and they don't necessarily have to turn into a recession. But usually when sentiment declines below a certain threshold, in the case of this chart over here, that would be below the 70 level. So this sort of gray line where my mouse is, that's often associated with a recession. The exception over here of 2011, going into the Euro sovereign debt crisis and sort of this fear of a double dip recession. But you ended up getting that low reading in 2022. And this is again where people were like, nah, Kevin, this is just the continuation of the recession we've already been in. But watch if this ends up rolling over. Tomorrow we'll get some consumer durable reports as well. That said, let's go over into our next survey here, which is the Richmond Fed index that also indicates that manufacturing activity slowed this morning. Wasn't too much to get out of this beyond that manufacturing activity did slow, which is somewhat in contrast to some of the more positive data that we got yesterday. But we also this morning had the Philly services report that came out. So you're getting a lot of these reports now over and over again, where it's kind of hard to say, oh, everything's great, because everything's not necessarily great. You are getting pain. Now, maybe that's a buying opportunity. Maybe all these surveys will flip-flop and everything will turn positive again. But what we want to pay attention to is what we got right here. Non-manufacturing activity in the region continues to decline. Now, this is in the Philadelphia region, so it's localized. But the index for general activity, new orders, sales and revenues remain negative, with the two former two declining further, with firms reporting a decrease in full-time employment and a decrease in part-time employment. But look at the rapidity of that drop over here on the right. This is why I think it's really critical that we start kind of getting over this tariff hump here, because we are at this position where we're kind of messing with the economy at a time where it probably shouldn't be messed with. Now, the stock market doesn't always reflect what's going on in the underlying economy, but a lot of these leading surveys could compound into some real poopy doopy. Now, what I would pay attention to are some of the data sets coming out future here. I'm going to go through some of them just so you have them. You can write these down on, your calendar or your, sticky note on your desk, whatever's good for you. But what you're going to want to watch for is the durable good orders we get tomorrow at 5:30 a.m. California time, durable good orders and durable X transportations. Durable good orders overall are expected to be negative 1%, and X transportation, so removing autos, they're actually expected to be plus 0.2%. I want to see if we actually get that plus 0.2%, because if we get negative and negative, not going to be great. Same thing is true for capital good orders. Are we still going to see this AI data center build out continuing? This morning we had a report that the chairman of Alibaba suggested that data centers are being overbuilt, and we're not matching the building we're doing with consumer demand for artificial intelligence. That yes, AI is great, but we're way overbuilding it. This is somebody in the industry essentially calling a bubble. These are warning signs, because when you have companies saying, hey, we're overbuilding with, things are uncertain, consumers are uncertain, and maybe we should wait and delay our investments, that's when everybody starts panicking, and together you actually self-fulfill the recession. So these are red flags that we want to pay attention to. Another thing, obviously, initial claims is such a lagging indicator. I don't really care about that one on Thursday. Wholesale inventories, retail inventories, we're expecting rises in inventories just to sort of pre-stock before tariffs. not uncommon. And then we have PCE coming out on Friday, along with the final read for March of that University of Michigan sentiment survey. It's actually expected to come in at 57.9, which is even lower than you saw on that 64 chart from the prelim read. So you could get a real, oopsie doopsie slip there on that chart when it updates on the St. Louis Fed website. On Wednesday, we'll also get the Atlanta Fed real GDP that should update to remove sort of the gold imports level. So we should see that go back to about my guess would be somewhere around 0.4. Well, that's what their guess was 0.4. But my guess is probably somewhere around like 0.4 to 0.8, somewhere in that range. And then on April 1st, we'll be getting our JOLTS reads, Dallas manufacturing activity, ISM manufacturing, and prices paid. The beginning of April data will be very interesting to see what kind of movement we got in March, especially with that April 2nd deadline looming. So anyway, this gives you a little bit of a look into some of the surveys and movements that are going on this morning. Really appreciate you being here, and folks, we'll see you in the next one. Goodbye and good luck.
Not advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.